Welcome to Hacker Trading. This is Hari Swaminathan. And in this video, I want to touch upon probability. We saw in a couple of earlier videos, we saw standard deviation. We saw what a one standard deviation move would look like. And we also saw what a two standard deviation probability is by looking at the Bollinger Bands. Now, probability is obviously a function of volatility as well as the standard deviation as calculated from past prices. So the calculation of the actual probability is probably a very complex topic, but Thinkorswim does a pretty good job about calculating this stuff, and it's all behind the scenes. So none of this stuff is really what we have to calculate. The platform itself does all of this stuff for you. So let's go ahead and take a look at Apple options. So Apple's symbol is AAPL. Apple's last traded price is around 571. And we're going to go into the August series, which have about 52 days left to expiry. And if we see here, Apple, and what I've done is, in addition to the implied volatility, I've created a column called probability of in the money. And now you can create various columns. You can create a column for probability of this option being out of the money, probability of touching, and things like that. I just wanted to keep it simple. Let's leave it at probability of this option going in the money. So what this means is we know that Apple's current price is 571. So let's say if we were going to sell this option. So if we were going to sell this option, we would sell 10 contracts of the 510 put, and we would collect a premium of $7.50. Now, of course, this is a naked sell. This is a naked put sell, which we would never do, but I just want to explain the concept of probability. And so we're using it as an example. In reality, you would never sell a naked put option unless you had a very good reason for it, which is to pick up the stock at that level. Now, that's beyond the scope of this video, and we've actually covered this on a different video in our module 2. So here we are selling 10 contracts at the 510 strike price when Apple is at a level of 571. So if we look at the risk profile, this is what it would look like. And what I want to do is bring this a little closer to the middle here. And so Apple's currently at 571. Our short strike price, we are selling this, so it's a short option. It's a short put. So even though it's short, it's a short put. So a short put is a bullish position. So if Apple goes up, we make money. Or if Apple goes down, as long as it doesn't hit the 510 strike price, we would make money. But if you were thinking of selling this put option, you know you're out of the money. So you have probability on your side. You have this much room to be wrong. So even if Apple comes down to 560 or 550 or 540, you can still make your full profit if Apple doesn't come anywhere close to 510. Now, in fact, on this particular case, your break even is at 502. So as long as Apple is above 502 when this series expires, you're going to make money on this trade. But you also want to get an idea of what this means for you. So you know you're out of the money, but what are your chances? What are you looking at? So that's exactly what the Thinkorswim platform provides you. So bear in mind, this is a complex calculation, but what we have here is this column called probability of in the money. So the strike price we have chosen is the 510, and the probability of this option ending up in the money by the day of expiry, on the day of expiry, is about 20.84% or 21%. So you can now get a pretty good idea of what are your chances? How likely are you to succeed on this trade? So if you look at all of those situations, then if you look at it from that angle, here it gives you a very clear idea that you have an almost 80% chance that your trade is going to make a full profit. And that's exactly why even your your reward is also not great because you've got probability. So you can't have everything. Either you have a nice reward, in which case your risk will be a little higher, or you have a small reward, but you have a very high chance of the trade working out in your favor. So that's exactly what this situation is. You have a reward of your maximum profit is going to be $7,300, but your margin is 53,000. So your profit is about 15% on this trade. However, your chances are actually about 80%. So that's how you would look at probability. Now, there's also another way to look at probability, and that's using the Thinkorswim platform itself, and you click on the probability analysis. So what this does is it tells you today the stock price is at 571. And so by the June quarterly expiry, it tells you what is a 1 standard deviation move for Apple. Similarly, if you move to the July series, you can see that the 1 standard deviation move for Apple will have a range between 527 and 614. Similarly, for August, we have a 1 standard deviation move between 508 and 633. So now you can see that our short option is at 510, and therefore 510 just falls into the 1 standard deviation range. So that's okay, you don't have to be picky, but this will give you a visual idea of where your position stands. So you're just inside the 1 standard deviation range, which is fine. That's okay. If you wanted to be a little bit more safer, perhaps you can sell the 505 rather than the 510. And now you'll see that you'll be just outside of the 1 standard deviation range. So this is how you would look at probability. And again, probabilistic mindset is very important when we deal with options and when you're dealing with the stock market in general. And of course, it can never predict what will happen in the future, but in general, you'll see that stock prices will over a longer period of time, it'll statistically tend to stay in line with your 1 standard deviation or your 2 standard deviation moves. However, that's not to say that in the short run, you could have an outlier of a reading. It's very much possible, and it happens all the time. So even though a reading might say a 2 standard deviation or a 3 standard deviation move might have less than a 1% chance of occurring, but in the stock market, you do find those outliers. So you do have to be careful about that, but that's why you have all kinds of adjustment options available when you're dealing in the options world. When you're dealing in stocks, you really cannot do anything. If you buy a stock and the stock goes down, there is nothing you can do except sell your stock and book your loss. Whereas in options, that's not the case. If you have an option that's losing money, you can always put another option that will negate the losses of your first position. So there's various strategies, and that's exactly what we teach here at Hacker Trading. As you go through the modules, you're going to start from the basics. You're going to understand everything, every little detail about all of these issues, and then we'll be progressing to the intermediate and advanced stages. So this was a primer on probability. Hope you enjoyed it. And if you have any questions, please send us an email at info@hackertrading.com. Otherwise, I'll see you in the next video. Thank you.